Okay, so in this vlog I'm going to be covering the trades from since the last vlog that we did, which would be for the 24th of April through the 30th of April, so basically the last week of April. Overall it was a really good week, and we closed out so that for 2017 year to date on the swing trader we're up about 47% per 15k traded, and then on the Crusher 2017 year to date we're up about 21% per 30k traded. Let me go quickly into the disclaimer. So as you guys are aware, we are not a commodity trading advisor. We're a third-party development firm, so what that means is that we're not registered as CTAs. We don't give personal advice. What we do is we offer our algorithms for use by individuals, and we don't control client accounts, and I think that covers the disclaimer pretty well. But just remember, past performance is not indicative of future performance. Trading options and futures involve substantial risk of loss. It's not appropriate for all investors. And when appropriate, I'll be talking about back-tested and also walk-forward returns, and also live. So when I do, I'll distinguish between them and have the appropriate disclaimers. So let me get on with the week though, and kind of show you how we did. Also, I want to mention at the end of the blog I will be talking about how we analyze algorithms, how we analyze the live returns, and how we know if or believe that an algorithm will continue to do well, or if there might be a problem with it. So once I'm done going over the trades for the week, I will be going pretty in-depth, showing you guys just the methodology that I use, and hopefully it'll be helpful and might shed new light for any developers out there, or people that are just kind of interested in learning more about algorithmic trading and quantitative trading, and just kind of how you monitor algorithms. But for 2017, I wanted to show this just another way of looking at the data. It's broken down by month. So for the S&P Crusher, which trades all 7 algorithms, trades on $30,000 increments, and like I said at the beginning, it's up about 6,350 for the year, or about 21%. So we've had 4 up months in a row on that algorithm. Now, just remember though, since it trades in $30,000 increments, the dollar gains on a percent basis are smaller. So that I just didn't want to confuse anyone when they see 4 up months, but then a smaller percentage up here compared to the swing trader. But the swing trader has done much better this year compared to the Crusher. On a percent basis, at least, it's also up about $7,196 per $15,000 traded, and that's about 47%. So it's been a great year for both the algorithms, but especially for the swing trader. It only had one down month, and that was in March, and it wasn't by a lot. April ended up closing out really strong at about $2,800. And of course February was a really good month for that package, which really helped. But so it's up though quite a bit since we went live, and then also for the year. So and if you want to see all the returns since we went live, then I just invite you to look at the website under the swing trader, and we go over the returns that the swing trader has seen since the algorithms in it began trading live back in October of 2015. But overall, both algorithm packages have done really well. So let me kind of talk about how each one did and go over the trades. So for the data that you're looking at here, this is for the entire year to date, and but I will be talking about this week in particular as we go on. But so again, it's up 7,196. It's about 47%. We've had 28 trades. 82% of them have been profitable, and the drawdown for the year it's only been about $1,800, and that was the beginning of the year. Right in here, you'll see it on the equity curve. But as the curve shows, the last week we added to the gains with I think it was only 2 more trades, but they were both really big and strong winners. So here's just the trade list from January through February, and then here you have March and April. So April we only had a couple trades on the swing trader, but they were all really good. And so let me go to the chart now and we can kind of walk you through some of the trades. So this is the momentum algorithm, and the last time I did the blog, we had ended the week of the 21st. So the chart would have looked about like that. And we did go long on that Friday when I did the blog. And on Monday morning, we had a huge gap up where we got out of the S&P minis with a huge gain. That's this trade right here on Monday. And then we bought back in at Monday towards the close. And we held on Tuesday and then also Wednesday. And then Thursday, we got out on the gap open. And then we got back in on Friday. And again, we're looking at closed trades. So we'll see how this trade ends up and talk about it on the next blog. But right now, this is still an open trade. It's just down a little bit. But the bottom line is we had two great trades on the swing trader and with the momentum algorithm. And what I want to do is I've done this a few times, and I kind of do it in every blog, I guess. But throughout the entire rally that the market has seen the last 4 months or so, well, really since November, the momentum algorithm did really good all the way up until March of this year, when the rally, at least for the moment, ended, and then the market sold off. And what you'll see is, as I talked about in the other blog, this algorithm is designed to do well in up-moving markets and also sideways, where the 10-year note algorithm is designed to do well in down-moving markets. And so by trading both of them, we are attempting to be market direction agnostic, meaning we don't care what direction the market goes as long as it kind of goes in a direction. But the momentum ES algorithm did really well, so you'll see that it shut off kind of at the end of March. Around the 23rd was the last trade. We got out of the trade we were in on the 21st of March. And the market rallied, then it sold off, then it rallied a bit. But what I think you'll see and hopefully be a little impressed with is how the algorithms were on the sideline, and that they really got in at the exact perfect time, kind of right before this new rally started again. And so, we're pretty proud of how this algorithm has handled the last week. And so, it is true that, of course, we got a little lucky with the French election being in the market's favor. But, someone could argue that maybe this rally before that helped tick some of the moving averages higher. That maybe some people knew or had different polling that might have suggested that it would be in favor of the market. Who knows? But in the end, when you trade, there's always a bit of luck involved. And so certainly, we had a great trade, and again, a little bit of luck is always involved, but the algorithms did do the right thing, and so I guess we're bragging about that, or I am. Yeah. So then, the next trade, the rally continued, and we got out. So great trades on the momentum ES algorithm. On the 10-year note, as I talked about in the previous blog, we got out of the 10-year note trade that we were in on the 12th of April. So just a little while, I guess a few weeks ago. We'd been in that trade for a long time, and as the market was selling off, the S&P that is, back here in March, 1st of March, through kind of the 13th of April. If I line that up here, this is about the 1st of March. And then the 13th of April was about right in here when we hit our target. So as the market was selling off, the 10-year kind of went sideways or I guess it went lower for a few days, but then it rallied pretty strong and hit our target. We did jump back in, and so now we have a new trade on with the 10-year. And we'll see how it goes. I mean, usually when the 10-year has a winner like this, in the back testing at least, it's usually been followed by a few more winners, and so that's kind of what we're hoping for, is something kind of like this back in January of 2016, where we got out of a trade and then we had another 4 winning trades in a row. So that's kind of what we're hoping for, and we'll see what happens, and I'll talk about it in the next blog, I'm sure. But for now, I think that covers the swing trader pretty well for the last week. Again, these two trades on the 24th and the 27th are the closed trades. The 24th, the trade on that was up about $1,100, and that's per unit traded, or basically per 15,000 traded, it made $1,100. And then on the second trade, it made about $800. Okay, so let me talk about the Crusher real quick, and then I'll talk about a few more other interesting things that, well, hopefully you guys find interesting. Okay, so for the Crusher, I'm going to do a similar analysis and kind of show you how it's done. So we're covering at least this data here, and this equity curve is for the entire year to date, and it's up about well, okay, so the S&P Crusher trades 7 algorithms. It trades a swing trade ES, swing trade TY, and those 2 algorithms are the 2 that I just talked about. So it trades those algorithms plus another 5. It trades the covered call, the iron condor, and then 3 day trade algorithms: the gap short, the day trade long, and the day trade short. So basically the Crusher trades 2 swing trade algorithms, 2 options algorithms, covered call and iron condor, and then 3 day trade algorithms. Okay, so the total PL on a 30K account would be about 21%. It's had 91 trades, 71% have been profitable, and the drawdown has been about negative 2390 in 2017. And again, we're just looking at this year so far, so that's so if you want to see the max backtested drawdown, just refer to the website. And of course, trading futures involves substantial risk of loss. It's not appropriate for everyone, and past performance is not indicative of future performance. So as I talk about the live trades, just remember that past performance disclaimer. But if we look at the trade list, it's going to be longer because, again, it trades 7 algorithms, and these are the 7 right here on these charts. So this is the momentum algorithm. This is the same one that the swing trader trades. This is the 10-year note, again, same one that the swing trader trades. And then there's also the covered calls layered on this chart. That's kind of this yellow line here. This one is the iron condor. You can ignore this chart. And then this one over here is the gap short day trade. This is the breakout long day trade, and this is the short day trade. So that gives you the seven algorithms. But let me go back to the PowerPoint. So we've already talked about all these trades in the previous blog, so I'll skip over those. Here's a continuation of the trades this year. So this is going through the 10th of February. Again, I've already talked about those. Here's February through March. We've also talked about all of these. And then here's the most recent. So the last blog I did ended on the 21st. So there's 1, 2, 3, 4, 5, 6, 7 new trades occurred kind of this last week, and I'll talk about those. One other thing that I wanted to mention real quick is in the previous blog, I believe we might have skipped this day trade that we show right here on the 5th. It was a loss of about $350. So it was kind of a small loss, but it's something that I think I might have missed on the previous blog, because there was a little bit of confusion over this trade, and we reconciled it. So I believe this is the correct trade, and what you see here has everything fixed, and so does these stats that you see here. They include that day trade that I believe, again, that we missed on the previous blog. But at any rate, so we've had 7 trades, and you'll see a repeat here. So this is the swing trade where it was up $11.75, and then this is the other swing trade that was up about $800. Let me talk about the other trades that we saw, though. So we did have 2 day trades to the long side, and so let me show you those, and they'll be on this chart here. So it's basically these ones here. So this is Friday, Thursday, Wednesday, Tuesday, and Monday. So the 24th. So we did have a long day trade here where we went long at the market on the 24th at about 7:48 Mountain. So about 18 minutes after the equity markets open, we bought the S&P, and then we got out at the close for just a very small gain. The next day we bought the market again, and then also got out at the close for another very small gain, basically break-even trades on these. So it was pretty uneventful on these two algorithms, but keep in mind that it's not that we missed these this up move that we saw here, because again we also trade the momentum ES, which did capture the gains, and so the idea is that by trading 7 algorithms, we it in theory at least offsets some of the risk because we're a little more diversified. It allows us to take advantage of potential breakouts to the upside that happen in the event that we might get out of a trade, kind of like we did here, get out of the swing trade. So there are times when we're long 2 S&P contracts. In fact, on the 25th, we would have been, when we bought here, because we would have been long already. If you look at this chart on the 25th, again, we bought the S&P on the 24th with the swing trade, with the momentum ES algorithm, so we were long coming into the morning, and then on Tuesday morning we're already long, and then we bought in again. So at this point we were long 2 contracts, and then we got out here of this algorithm, so then we would still be long this contract from the swing trade momentum ES algorithm, but we would have gotten out of the day trade. So these are separate algorithms running, but when you look at your account, you might see that we're long 2, and then the close comes and now we're only long 1 again. Well, all that's happening is that the multiple algorithms are triggering, and so it creates, when you add them together, just 2 long positions. But we don't ever hold 2 S&P contracts overnight, at least the futures. We could still hold the options positions though, but yeah, so hopefully that helps as well. But so we did have those day trade algorithms triggered, the 2 day trades there. We had the 2 swing trades, I already talked about those, and then we had 2 options trades triggers as well. We had a covered call trigger, so let me show you that. So on Monday, again, this is Friday, Monday morning we got out of the S&P. At the close of Monday, we actually sold the 2380 calls, the weekly calls, which the strike price on those would have been right in here at 2380. So we were short the 2380s, and when we do that, it's really creating a covered call position, meaning if we go above this line and close above this line and we're in this position, then any gains above this line are break even basically, because we're long the S&P from the ES, but then we're short the options, the call, that is, which is similar to being basically short at 2380. And I don't want to confuse people, but it's probably good that I just talk about it quickly. So when we do that though, as this chart shows, if we get out of this position like we did here on this gap up, we're still short the 2380 call, so it's not really covered at that point anymore until we get back in. And so what that does though is it creates these really interesting situations where we might be out of the ES, so that's good, we took profits on it, that was that $800 gain, and we're also still short the 2380 call though. And so really what we want is the market to sell off a little bit just to be below this 2380, but then not enough so that we get stopped out of any ES position we're in. Because what that allows us to do is if that happens, and that's exactly what happened here, so it was almost perfect for us. It would have been a little bit better if it would have gone just below 2380, but on Friday it closed at 2381.75. So it was 1.75 points above our strike price, but we collected 3.7 points, so it was still profitable by $100, because basically you take the 3.7 and you take away 1.75, and whatever that number is, about about 2 points, then you multiply, each point is $50, so it's about $100. If this would have closed just below 23.80, the call would have been worthless, which is good for us, and we would have kept the full premium. But at any rate, it was still pretty good because it was profitable. So we were, very pleased with how the market closed Friday. So the covered call was a winning trade, and not only that, but the market didn't sell off so much that we got stuffed out of our S&P. So what we're hoping for Monday is some kind of a gap up where we can get out of this position, and then we basically have three kind of winning trades: the call, the short call, and then an ES trade here, and then another one here potentially. But let me talk about the iron condor though. That was the other trade that we had. So when we do the iron condor, we sell a put and we also sell a call, and so a very similar kind of event happened. Let me move this to be a little bit more where the 2365 is. So on Monday, this is Monday right here, and then Tuesday, Wednesday, Thursday, Friday. So around the same time that we sell the call on this covered call on Monday, we also enter into an iron condor position. Now the iron condor, really what we're hoping for on that, and you can Google what an iron condor is, but we're basically selling a call, very similar to the covered call, but then we also sell a put. And so what that does is it creates a bracket. And what we want for this trade at least is for the market to close in between the call and the put. Now when we do that, we also buy a call and we buy a put that's deep out of the money, and we buy them really cheap for like one tick on the S&P usually, which is only $12. So we buy that just in case the market just takes off huge against us, because at some point our long call will become profitable, and then any losses above that, if it's a huge rally, any move higher than our long call will be offset by that long call, so that the losses that we would see on the short call don't get out of hand. But this algorithm is designed to do well in sideways moving markets, and probably last vlog I talked about this trade here where it was actually perfect. It closed right in between the call and the put. Well, you can see kind of how this algorithm, one of the strengths of it is that it is looking for sideways movement, but because we buy at the end of Monday, if there's a gap up on Monday morning, which I believe the data shows, and I haven't done the full analysis, but my recollection is telling me that there's been studies that show the majority of the movements that happen on the S&P happen over the weekend, basically. So between Friday and Monday, the vast majority of gains seen on the S&P in the last 20 years, or it might have been longer, study that I saw, the vast majority of the gains happen on just over the weekend, the gap up. So traders get out of the S&P at the close, and they don't want to carry the overnight risk, so then a lot of them might enter back in, but the buying pressure or the demand pushes the futures higher, basically. And so so the good thing about these options trades that we make is that we place them at the end of Monday, so it offsets the risk just a little bit. I mean, it's nothing is risk free, but we at least don't carry the overnight risk of some really big news coming out over the weekend, and then we're short a call or short a put. So this week though, we at Monday's close we sold the 2380 and also the 2365 put, and kind of like I already talked about, the S&P closed about 1.75 points above our call, so it was just barely in the money on the call, but the put was 100% profitable, so that's good. And when the market is drifting higher, for whatever reason, usually we're able to get more on the puts, and so that's kind of good if it has a bias to the upside still for us. But on this trade, we so on the put leg we made 306, and on the call leg we made 97. So it's the same that we made on the covered call. It's The only difference is the commission is a little bit more that the brokers charge because we are also buying a call. So so that's why it's $20 here. But in this -13, that's the protection that we buy, and then the -30 is the protection on the put side. Yeah, so just again real quick, I'll go over some of the highlights, which I kind of already did, but and then I'm going to talk about something more interesting that at least for me, which is how we analyze the performance of an algorithm, how we compare the backtested with the walk forward. But the big highlights were for sure the swing trade ES did amazing. It had those two trades I showed you. Yeah, the first trade, and I've talked about these enough, I think, but let's see. Yeah, so it performed positive during sideways and upward drifting markets, and once again it showed that it was able to do that. The other highlight is probably this iron condor trade. It was actually a really good trade because with all the volatility and the movement the market's seen, for the most part it got it right. It was up a total of about 300 and let's see. There it is, $320 when you factor in commission and slippage, or I'm sorry, commission and the protection. And so on a 30K account, like the Crusher trades, that's about a 1% gain. And so it might not sound like a lot, but if we do 4 of those per month and they're all profitable by 1%, it adds about 4% to the performance. But again, as most of you know that have watched my other blogs, you know that our methodology is not necessarily to have one algorithm that can do good in every market condition. Instead, what we do is we trade 7, and each algorithm has a job. So this momentum, it's designed to do well in up-moving markets, and so it fills that gap for us. The day trade breakout algorithm is also designed to do well in up-moving markets. The iron condor is designed, it was actually designed to do well in sideways moving markets, but it just so happens to also do good in up-moving. And then for down-moving markets, you have the 10-year note algorithm that just usually will hit it out of the park when you have a down-moving S&P market. And then we have 2 day trade short algorithms as well that do well. And then the other way that we help fill the sideways moving market condition is also in the 10-year note. So the 10-year note will also do good in sideways. So it does good in sideways and down moving markets, up and sideways moving markets on this one, up and sideways moving markets on the iron condor, up moving on the breakout day trade, and then this one, these other 2 day trades do good in down moving markets. So the idea is that you have a couple algorithms that do good for each market condition, and then the key is you just can't have them lose a lot in the contrary market conditions. And I'm gonna talk about that more in these other slides that I'm gonna go through. But for the most part, that covers the performance we've seen on the last week. And now what I'd like to do is just do a real in-depth analysis of one of the algorithms and talk about kind of back-tested versus walk forward, and just kind of go over some of that with you. So so let me kind of start doing that now. But overall for the week, algorithms did amazing, and for the year, they're both of the packages are doing really well. All right, so at least for me, this kind of I don't know, presentation is way more interesting to me, and I hope that you guys find it helpful. But what I'm going to do is I'm going to talk about just kind of part of algorithmic trading or quantitative trading that I think a lot of people are just not as aware of some of the ways that people analyze algorithms and see how they're doing, and basically measure their performance after they go live. So before I do that, though, I just want to go over real quickly some of the terminology. So as most of you are probably aware, when we code an algorithm, we basically code it and we backtest it, and we run optimizations which will analyze the algorithm and determine, you know, what the best stop is, the best target. If it's using something like a moving average, what the best moving average length is, and then and that's all done. At least for me, I use the TradeStation platform. And what that does is it'll create all these reports, and it lets you just analyze the data, and then once you have an algorithm that you feel good about, then you might trade it live. That's the most basic kind of overview of algorithmic trading. But what most developers will do that that kind of know what they're doing, I guess it's safe to say that, is they'll also do what's called a walk forward analysis. So when you do backtesting, it's always going to be the most optimistic model, and it's just the starting point for most algorithms. What walk forward analysis does is it'll run the it'll optimize using an an in-sample data set. So for example, on this this algorithm, the Momentum ES one, the one that's done really well the last year or so, it might backtest from 2003 all the way through, I don't know, 2009. And then what it'll do is it'll step forward and see how the algorithm did, had it been created back in 2009, how it did the following year, and then depending on the kind of walk forward simulation you're doing, if it's it might be kind of a moving optimization or an anchored one. And so what it'll do though is it'll see how it did in 2009, and then it'll re-optimize including the data from 2009, and see how it did in 2010, and then re-optimize including the data from 2010, see how it would have done in 2011, and so forth. And what that does is it gives you a more pessimistic expectation for what an algorithm might be able to do. And if an algorithm is poorly coded or has a ton of technical indicators, then it more than likely will fail the walk forward analysis when it's run. Now when you do walk forward in TradeStation, they have a tool that allows you to do a matrix where you can set the in-sample and out-of-sample data to almost anything you want. So it might only backtest, I don't know, a year instead of 10 years, but then step forward every 3 months and then re-optimize, and you can create a matrix. But that's, when I talk about walk forward analysis or walk forward results, I really am not, in most cases, I'm really not talking about that. What I'm talking about is more of a blind walk forward, where it's the results that have been seen in kind of a blind model where the original code was never even developed using that data, and then walked forward, meaning the results that algorithm would have seen since the last optimization. So when I say blind walk forward, that's really what I'm talking about, and most of the time that I talk about walk forward, including in this presentation, that's what I am talking about. Now there's also live trades though, and live trades are very, in my mind, similar to the blind walk forward. The difference is the live trades have the actual fills, and so there's no slippage included. But both blind walk forward and live trades are going to be the most realistic view of how an algorithm will do when you're looking at reports, and people are talking about all these different kind of simulation modes or live trades. That's kind of what they mean. So the backtested is going to be very optimistic, and a lot of people don't even like to look at backtested for good reason, because it can be over optimized. You know, if you flip a coin 100 times and then log, you know, heads, 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 tails, tails, heads, tails, heads, tails, I could write an algorithm that would search through that and find a pattern. But as everyone knows, that doesn't mean that that's accurate, because every time you flip a coin, there's a 50% chance it's going to be head or tails, as long as it's not weighted. But if you, but maybe in that 100 flips, maybe it just so happened that the majority time when you got a pattern like heads, tails, heads, that the next time it just happened to be heads. But of course, that doesn't mean that that's a real pattern. So That's the best way I think I can explain what kind of an over-optimized model is. But when you're talking about blind walk forward and live trades, that's something that you can't really optimize, because it's the results after the optimization in time, meaning the code was not developed using that data. So even walk forward analysis, this number 2 one that I first started talking about, where you have the matrix, I think that can also have potentials for over optimization, because you can basically set up the matrix to just pick whatever kind of in sample / out of sample period or data work the best, I guess is what I'm saying. But when you do blind walk forward, which is the hypothetical account, the real data, or the hypothetical trades after the optimization in real time, then that's going to be more than likely very accurate. There's still disclaimers with hypothetical accounts, of course, because you don't know if you get the right fill, and that's why you add slippage. But then live trades are the best. So I think I've talked about that enough. So let me get into how we analyze an algorithm now. Okay, so what I decided to do is do a case study of the momentum ES algorithm. And again, that's the algorithm that this week happened to do really amazing with these 2 trades that we saw here. And this algorithm has been trading live, and it's one of the algorithms traded in the swing trader. So it's 1 out of 2 of the algorithms in the swing trader, which would be over here, I guess. So it's this one here. The other one is the 10-year note, and then it's 1 out of 7 that's in the Crusher. So anytime I start analyzing the algorithms, I always look at them at an individual basis first, because they're their own algorithms that just happen to be trading as part of a collection of algorithms. So I'll look at each algorithm individually, and then I'll also look at how they contribute to the entire package of algorithms. But for the purpose of this talk, it's really going to be focused on just the momentum ES algorithm, and then towards the end I'll talk more about what the data means and what it means as it pertains to being traded in other systems like the swing trader or the S&P Crusher. But again, this algorithm is designed to do well in up and also sideways moving markets, and then to just to hopefully not lose a lot when the market goes lower. But this algorithm has traded live since October of 2015. Originally it was traded in a package that we called the Gambler. That package, because it was a horrible name, we decided to change the name to where it went to, I believe we called it the ESTY, and then now it's just traded in the swing trader and then also the Crusher. But the let's see, yeah. So it was backtested though between May of 2003 and October of 2015. So it's been over 18 months that it's traded live now. And this is the backtested results of this algorithm alone. So again, only this algorithm. It's had, believe it or not, exactly it had 1,000 trades in the backtesting. The percent profitable was 77%. The max drawdown was about $9,000, and that definitely always felt relatively high. But when you keep in mind that this algorithm trades along with algorithms that do good when the market goes lower, then the entire drawdown of the complete system of all 7 algorithms, or even all 2 algorithms in the swing trader, this drawdown is smaller, because some of the losses that are seen on the swing trade ES are offset by gains from either shorting the ES or gains on the 10-year note. So yeah, that's probably enough on that. But the average gain per trade is about $56, and that includes winners and losers. So it's the overall average if you take these 1,000 trades, and that's how you get if you have 1,000 trades times $56 each trade, that gives you about 56K that this made in the backtesting. Now remember this disclaimer on the bottom, that pertains to backtested results. So just again, the disclaimers are accurate. The backtesting has significant limitations, and so we always like to make sure we have that disclaimer there. But here's the equity curve. The average per month is on this algorithm is $434. So you could kind of do the math and see that it averages about maybe 8 trades per month, going all the way back to 2003. So in that 12-year period, that's the average per month, and the percent gain here, that's assuming a 15K account. And I think the reason why we have 15 there is just because if somebody wanted to trade only this algorithm, it requires really only $5,000 of margin in the account. So someone with 5K in their account could trade this algorithm. But if they went through the biggest drawdown that it's had in the backtesting, it shows they would really need 15K and to account for that. So that's why we have the 15K here, and then we have the average per year. So that's the backtesting though. And again, this max drawdown is only for this algorithm, and when you combine the other algorithms, it goes down. So yeah, so let me talk about the walk forward now though. So the walk forward is really, we're talking about the blind walk forward, meaning I optimized this algorithm 18 months ago, and going forward in time, based on data from October 2015 all the way backwards through May of 2003. And then since then it hasn't been touched in the optimizations, and so this is a solid kind of blind walk forward results that this algorithm has seen. So and the reason why I'm showing you both, and I'll get to it in a second, but when you always start with the backtested, and again, this is in theory the optimistic version, because it has the potential to be over optimized. And if you code 100 algorithms, in my opinion, at least when you're starting out, you're going to be lucky if 3 of them do as good as the backtesting did. And over time you kind of learn what makes an algorithm a good one. You don't want to have really anything more than 2 technical indicators, in my opinion, is too many. Maybe 3 is okay. And then you don't want to optimize on a super granular level. I mean, there's really a lot of different things that you need to look out for, and in our white paper I kind of talk about that, but not to get distracted. I guess it's too late. But but I'm showing the backtested as kind of our starting point. So this is what we want to compare our live returns against and see if we are matching the backtested. Because obviously this backtested equity curve is really good, and most people would love to have an account that that through 2003, including in 08 when the market sold off and we went into that bear market, that it would have kind of prevented massive losses at least. But so this is the backtested, and then if we look at the kind of walk forward stats, so it's had 138 trades since October of 2015. 76% have been profitable. The average trade has been $81, and then it's traded live for about 19 months. And here's the similar stats and equity curve. So this first trade here would have been around October of 2015, and then this last trade on 139, that actually these 2 trades would have just been from last week. And so so that's just to explain the data that I'm showing you, that's kind of what we're looking at. The max drawdown that we've seen in the last 19 months since going live has been about $4,400, and you can kind of see that probably right in here where it hit a peak of just over 2,100, and then it went down to about 17K. So that's the drawdown. Those are the losses that this algorithm would have seen. And you can pause this if you want, but I'm going to talk more about the comparison though in the next slide. So so far what I've done, I've shown you the back-tested, the optimistic. I've also showed you the kind of blind walk forward. So I want to talk about now is how do we use this data, and why is it helpful, or is it helpful? So the number one thing that I'm looking for, and I believe most developers probably follow a similar model, but I prefer to see about 10% of out-of-sample data. I definitely want to see at least 200 trades in the back testing, and so that would be about 20 trades in the walk forward in that example. There's a lot of other things that I look at, but just to give you an idea, we prefer to see 10% of out-of-sample data, meaning if I design an algorithm and it's back-tested 15 years and it has 1,000 trades, I really don't look at it too closely, the first 20 trades it has, because that's 20 trades out of 1,000 is not even, well, I guess it's about 2%, and it's just not enough to really gauge how well an algorithm has done. Now, the only exception to that would be if in those 20 trades the algorithm just completely fell apart and went below the max back-tested drawdown, then there would obviously be concern there. But in general, I try not to look too closely until we have about 10% of out-of-sample data. And in my experience, usually after a year of trading an algorithm live, we have usually about 10% based on at least the duration that we backtest, which is as far back as we can go when you include the 10-year note. But so in this case, the first question is, do you have enough data? Prefer 10% of out-of-sample. And in our case, the Momentum ES algorithm has 1,000 trades back-tested, and in the blind walk forward we have 138. And so that is about 13.8% as of today. And so we definitely have enough. And I've done this analysis a few months ago, and actually I believe about 6 months ago. So this is almost just kind of an update for me. So we definitely have enough trades to continue analyzing it. And so the things that you want to look at is you want to say, well, does the walk forward win rate, is it within reason to what the back tested was? So if the back tested had a 77% win rate, and again, back tested is the optimistic model, the blind walk forward had a 76% win rate, so it's only 1% lower, which is great. Usually, believe it or not, the efficiency that people are typically looking for is about 80%, meaning, and I don't know if that really applies to the win rate, but definitely on the other stats it does. But it basically means as long as you're within 80% of what the backtesting shown, then it's more than likely a pretty good algorithm, or at least the algorithm should continue to do well. Of course, with all the disclaimers that no one knows for sure, but it gives you a good idea that it will if it has an 80% efficiency. In our case, it's well, way better than an 80% efficiency. It's actually really almost exactly the same, so that was good. The other thing that I'd like to look at is, does the average gain per trade match within reason? And this is some data that really kind of amazes me, and for sure, we're looking at the momentum algorithm, which is done really well. I could also look at the 10-year note algorithm, and I'll probably do in the next blog, I'll more than likely look at that and do a similar analysis that we're doing now. But right now we're looking at the Momentum ES algorithm. The backtester is 56 per trade. The blind walk forward is 81 per trade, meaning since our last optimization, this algorithm actually has done way better than the backtesting. So that's great. If you, because usually you're more used to seeing an algorithm do not quite as good as the backtesting, but to see it do this much better, is really a good, it's just strong evidence that this algorithm really is a solid one. So the other thing that I like to look at, and this is very common, almost everybody probably looks at this, but it's, are there any drawdown concerns? So in other words, if the back-tested drawdown was 9,082, so 10% of that would be about 900. So if you add about 20% maybe for the efficiency, So roughly at about 2,000, that gives you an $11,000 drawdown that you want to make sure that the blind walk forward doesn't surpass that. In our case, no problem. We haven't even come, well, we're about, the worst we came was about halfway to the back tested. So it's definitely within reason. There's no concerns here at all on the drawdown. But I have had algorithms where the back tested drawdown is one number and then the walk forward exceeds that back testing. That's usually when it's time to reevaluate the algorithm. So this would be a big red flag if in our live trades we had exceeded the back tested drawdown. But those are three pretty simple things to look at, I think, that give you an idea of how well the live returns have matched up with the back tested. But the other thing I want to talk about is how does it perform on based on various market conditions. So again, this is just the momentum ES algorithm. So one algorithm out of the 2 in the swing trader and one out of the 7 in the crusher. And these are the returns that it has seen since going live. And the reason why I look at it this way as well is because as you dig kind of a level deeper beyond these 3 points here, the percent win rate, the average gain per trade, and the drawdown, the next thing I do, assuming that those are good, is I'll look at how did the algorithm do based on the various market conditions, the strong up, the sideways or drift higher, and the down. And the reason why I do that is because, again, these algorithms fit into a system, and I might have one algorithm that does really good in strong up, but then bad in down, and then maybe break even in sideways. That's okay as long as I have a couple other algorithms that do good when the market goes down. Now we're looking at one algorithm in the entire system, and this one happens to be the one that does best in the back testing during strong up moving markets. And so my expectation would be that if we have a strong up market, and in the analysis I did a while ago when I designed these algorithms, I defined it a strong up as the S&P closing by 30 points higher or more for the month, which is about a $1,500 gain. And a down month would be if it closed 4 points or more, and then anything in between would be sideways. And the reason why it's 4 points down for the down and then 30 points up for the up is because I wanted it to be kind of a third between each month in that kind of 15 years that I looked at it. But again, I know that's probably confusing, so I don't want to talk too much about that, but it's just to say that we have ways of defining whether the S&P was up, down, or sideways. And then what we do is we compare how the algorithm did in those conditions. So for example, again, if this algorithm is designed to do well in up moving markets, then I definitely am going to look first at up moving months on the S&P and make sure that this algorithm did well. And on these months where this algorithm lost, I want to make sure that those weren't up moving markets, because if they were, then that would be a sign that this algorithm is broken, or it's at least not doing its job, and we missed something in the analysis. Because again, this one's designed to do good in up moving markets. Let me go to this slide, and this is probably maybe the most interesting slide that I've gone through yet in this blog. Because what I've done is I've noted, so right here is a chart of the S&P, a monthly chart going back to October 2015. That's this first month right here. So this is October, November, December, January, all the way through. This is April of 2017, and so this gives you all, 18 months or 19 months, I think, of movement on the S&P. And then what I've done is I've identified for each month in this period, how did this algorithm do, and was it a strong up, a down month, or a sideways month? And I think I think this will be interesting to people. I mean, it definitely is to me every time I look at this kind of data, because what it shows is if the S&P had a strong up month, this algorithm more than likely had a good up month as well, which makes sense because it buys the S&P. And so if the S&P closes up, more than likely it's going to also do well. And so what you'll see is, you have October 2015, it was up about, almost 5,000. In March of 2016, up almost 4K. And then you had a couple 2K months, July and November, and then February about a $2,400 gain, January a $1,000 gain. And then these two with the stars are the only ones that they didn't necessarily perform as good as we might have expected. So December 2016, it was up $400. May of 2016, it was actually down 50, and we'd have to look at May to see why. More than likely, May sold off and then rallied and probably barely closed up 30 points, I imagine. But when you add up all of these months together, you see that the majority of the gain that this algorithm had was when the S&P was up, and that's about 16K. Now, when you look at the down months, and there were really only 3 since 2015 where the market closed down by 4 points or more for the month. Well, January was really good, January 2016, because we had no trades, and meaning the market sold off and our long algorithm successfully got on the sideline and wasn't trading. And then, again, just to reemphasize, this is one algorithm in the packages, and so even though this algorithm didn't have any trades, more than likely the 10-year note algorithm had trades, and for the Crusher, the 2 day trade algorithms might have also had trades. So it doesn't mean that the entire system was at a loss in these down months or in these sideways months. It just means that this algorithm, the one that's designed to do well in up-moving months, had these numbers. And so, again, the reason why I do it is to make sure that in strong up months, this algorithm has performed well, and also to make sure that in the other months it just doesn't lose a lot. You don't want, it's great if you can make 4K in March 2016, but it's not good if in April of 2016 you give back the 4K plus another K and you have a down $5,000 month. And that's what makes momentum trading and these kind of algorithmic trading is probably the most difficult part, is preserving gains, meaning anyone can buy when the moving average is ticking higher, but how do you make sure that you don't lose a lot when it starts going sideways or kind of going up and down, and so the moving average, that is. So that's why we do this. And in this analysis, the point was to try to make sure that there's that it has real solid gains in up months, and then in down months it hopefully doesn't lose a lot. But if we look at the down months, for sure January was a great down month because we had no trades. December 2015, October 2016, we had kind of small losses on this algorithm, and that's okay. This is all within reason. Being down, $1,000 for the down S&P month, there's no problem with that at all, as long as you're making $2,000 on the up months, or even more potentially on some of them. So this is all good. None of this was of any concern or surprise, really, because this is the kind of thing that you see with these algorithms. And the other interesting one is when you have a sideways month where the S&P closed between down 4 points and up 30, and this is also pretty normal, or pretty much what we would have expected. There's definitely more sideways months, or kind of in between up and down months. A couple things to point out, though, is a few of these months were profitable. So April 2017 was one of them. We were actually up about 1900. So April, for the most part, was a sideways month, and that's actually a good one we could look at now. So April closed at about 20. Let's see, right in here, about 2364. And it closed the month at about 2380. So it was only up really about 15 points. But you can see it sold off at first, then rallied, and so it's great if we can do 2,000 in a sideways month. The other things I want to point out, so April 2016 was not a good one. We took about a $2,000 loss, and we'd have to look at that and see why. But again, when you average it all out, these aren't huge concerns. It's just things, the things that I'm kind of looking for is, which periods did it not behave closer to what I would have expected. It doesn't mean it's broken. In fact, the opposite, as this data was showing. We're actually doing way better than the backtesting had shown. It's more just to continue the analysis and dig deeper and see, okay, well, what's kind of going on when you look kind of a level beneath the top level numbers. So some months it loses 900, a couple months it lost 240, here it lost 93, here it made $30, here it made almost 2,000, lost about 1,200, and lost about 2,000. So when you add it all up, though, it's in sideways months, this algorithm has been down about 2,400. In down months, this algorithm was down about 2,800. But then in up months, this algorithm was up about 17K. So when you add it all together, you definitely have a profitable algorithm. And again, past performance is not indicative of future. And I just want to emphasize one more time that that this does not mean that our algorithms do bad in down months. It just means if somebody was only trading this algorithm, then yeah, it's not going to do great in down months. I mean, it still doesn't lose a lot in theory, and that's what we've seen so far. Because even in down months, it loses 1,000, but in up months, it typically will make a couple thousand. And if you average this out, I believe it is right at 2,000, I believe, because I think there's 8 months here. Yeah, so it averages out to up 2,000 per month, and this averages to down about 900 on the down months. So overall, it's all really good news. And I think that summarizes everything I wanted to talk about. This has been a longer blog, so I'm not sure if anyone's even watching anymore. But if you are, thank you. I know it's been exciting. Actually, for me, doing the analysis that I just did that's the kind of stuff that I actually really enjoy doing and talking through and looking at and kind of sharing, because it does give you a little bit deeper understanding of our methodology and what we're doing, and in my opinion why for the most part we've been successful with the algorithms. Just always remember that well, number one, trading futures involves risk. I'm showing the positives. There's always negative as well, but for the most part these algorithms have done simply incredible since they went live. And as these summers have shown for the year to date, we're up pretty huge on them. So it's been a great run with these algorithms, and we do have no reason to expect that anything different will happen. We've seen up months, down months, sideways months, and we've seemed to do well in all of them. So overall, we're excited about finishing out the year. We're 4 months into it, and we have a huge lead. And hopefully in the next 8 months we see additional gains, and that's certainly what we expect. If the market starts to sell off, then what our expectation is that this momentum algorithm will quiet down just like it did here. Because if the market would have kept going lower and just sold off for a few months, we just would have been on the sideline, because this shut off back on the 24th is the last trade it had. And what our expectation would have been is that if that would have happened, the 10-year would have kept going higher. And so when we jump back in, maybe we have a string of 4 of these winning trades in a row, which the last time we had a winner like this, I believe we had another 4 winners after it that lasted about 2 months. So that's kind of how these algorithms work. And it's okay if the momentum algorithm takes losses in down months, kind of like that graphic or this data showed that we were looking at, as long as we have an algorithm that does well in the down months to make up for any losses that we might see on this one, and then not only make up for the losses but have gains. So I think I've probably talked enough about all that, but thanks a ton for following along, and I hope it was helpful, and that it maybe gives you a deeper level at how we analyze the algorithms, and And I'll just close with, again, the disclaimer: past performance is not indicative of future performance. With the live results, the back tested, we had that CFTC, the required disclaimer that talks about that. You can pause the screen and look at it closer. And I think that's it. So have a great day, and look forward to talking to you perhaps in about a week. Thanks. Bye.